Welcome to another TCP walkthrough video. I'm Logan, and in today's video, we're going to be going over corporate limitations on the use of NOLs amid ownership changes. And we're going to be doing that the SuperfastCPA way, which is diving straight into questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We teach the key ingredients to passing the CPA exam. Again, it's only 1 hour long, it is free, and we will save you so much time struggling with your process. Make sure you go check it out. Also, just letting you know, we will only be going over 5 questions in this video, but Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a Superfast CPA member. With all that said, let's dive straight into the questions. All right, here we are at question 1. Which of the following situations would likely constitute an ownership change under Internal Revenue Code Section 382? So, if you don't really know about NOLs or how they work with corporations or what Section 382 is, that's okay. We're going to be talking about all of that in this video, so let's go ahead and go straight to the answer to start learning a little bit about these rules. Okay, the answer is A. A single shareholder increases their stock ownership from 30% to 80% within a 3-year period. Okay, so let's dive into this to kind of figure out what's going on. Under Internal Revenue Code Section 382, an ownership change occurs if shareholders who own at least 5% of the company's stock, and these are referred to as 5% shareholders, increase their collective ownership by more than 50 percentage points over a 3-year period. So if this happens, if 5% shareholders increase their overall ownership in the company by 50% over 3 years, then that's considered an ownership change. And we're going to talk about it more in the video, but this can cause some limitations on how NOLs are used. So in option A, it's pretty obvious. A single shareholder increases their ownership from 30% to 80%. That's 50%. This is significant because it contributes to the overall shift in ownership. So all it would take is one more percentage somewhere else, and this would be considered an ownership change. If the total increase in ownership by all 5% shareholders exceeds 50 percentage points, again, it triggers an ownership change. And so that's where net operating losses are going to be limited. So let's learn some more rules in the next questions about how to calculate this limitation and some other things. Okay, here is question 2. How is the annual limitation on the use of pre-change NOLs calculated under Section 382? Just remember, Section 382 has a lot to do with these NOL limitations for corporations and ownership changes and things like that. So yeah, how is this calculated? If you don't know, that's okay. Again, all of these questions, we're looking at them to learn together and explain it together. So let's look at the answer here. Okay, pretty simple. The fair market value of the lost corporation's stock immediately before the ownership change multiplied by the long-term tax-exempt rate. So we're not going to talk about the specific tax-exempt rate because that can change from year to year, but the basic idea is you take the fair market value of the corporation's stock right before there was the official ownership change, and then you multiply that by the long-term tax-exempt rate. And this is how you calculate what the limitation is on the NOLs. This limitation restricts how much of the NOLs can be used each year to offset taxable income. So again, this is all about limiting how much the NOLs can be used against taxable income in the years after the change of ownership. Let's go to the next question. Okay, here we are at question 3. Which of the following statements about built-in gains and losses is correct under Section 382? So first off, what are built-in gains if you don't know what those are? And what happens if there are built-in gains and losses that are recognized? Will that affect the NOL limitation? We're not sure. So again, let's go to the answer. Okay, the answer is that built-in gains recognized within 5 years of the ownership change can increase the annual limitation. So a built-in gain is an unrealized gain on an asset that existed at the time of an ownership change, but has not yet been recognized for tax purposes. So again, let me just reiterate that. This is an unrealized gain, so a gain that you didn't realize yet on an asset, and this unrealized gain was sitting there before the ownership change. If this gain is realized within 5 years of the ownership change, it can increase the annual limitation on the use of net operating losses under Section 382. So this can affect how much of the NOL you can use year to year if you have these built-in gains that start being recognized after the ownership change. All right, let's go to the next question. Okay, here is question 4. What is the continuity of business enterprise, or COBE, requirement under Section 382? So again, we don't really know what all of this means, so let's go ahead and look at the answer. All right, the answer is B. The corporation must continue to operate at least one significant historic business line or use a significant portion of its historic business assets. Or basically, the corporation has to keep doing some of its business operations that it had previously. The continuity of business enterprise or COBE requirement under Section 382 mandates that the corporation must continue to operate at least one significant historic business line or use a significant portion of its historic business assets after the ownership change. Again, we just kind of talked about that. This ensures that the business remains fundamentally the same and prevents companies from acquiring loss corporations solely for their tax benefits. So it prevents them from acquiring these loss corporations and changing up the business a whole bunch. Let's read what a loss corporation is. A loss corporation is a company that has net operating losses, which it has not yet used to offset taxable income. This matters because Section 382 imposes limitation on the use of these NOLs after an ownership change to prevent companies from acquiring loss corporations primarily to utilize their NOLs for tax benefits, ensuring the losses are only used by the business that incurred them. So let me just kind of explain that a little bit more. After an ownership change, this continuity of business enterprise requirement basically is trying to say, after the ownership change, you can't just acquire other corporations that are having losses or a loss corporation to then use their losses to offset your taxable income. It's basically saying that the NOLs are limited to the business that incurred them so that they can't just acquire a whole bunch of businesses and use their losses to offset their taxable income. So that's just another part of this Section 382 about net operating losses and corporations. Let's go to the next question. Okay, here is question 5. Under what condition might the annual limitation on the use of NOLs be increased in the context of a bankruptcy proceeding? Okay, so how does a bankruptcy proceeding affect this? That could definitely incur an ownership change. So let's look at the answer to learn about this. Okay, the answer is B. If the creditors and shareholders of the old loss corporation end up owning at least 50% of the new loss corporation. So in a bankruptcy proceeding, if at least 50% of the people who were a part of the bankruptcy corporation, like that loss corporation, end up owning the new loss corporation, the new ownership of the new loss corporation, then that can change the annual limitation. In the context of a bankruptcy proceeding, the annual limitation on the use of net operating losses might be increased if the creditors and shareholders of the old loss corporation end up owning at least 50% of the new loss corporation. This provision aims to facilitate the reorganization and recovery of financially distressed companies by allowing greater use of their NOLs if the original stakeholders maintain a significant ownership interest post-reorganization. So kind of helping these people by letting them use more of their NOLs in this situation. All right, we've learned the basics of NOL limitations for corporations in these 5 questions. Before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions, you will notice the things that keep popping up. You will notice topics and equations and things that are obviously important according to your review course because you've seen multiple questions trying to teach you them. So you take a second and you write down these pillar topics so that you know them and remember them for later. So let's go ahead and look at the pillar topics for this video. Okay, here are the pillar topics. First off is the ownership change definition. An ownership change occurs if the ownership by 5% shareholders increases by more than 50 percentage points over 3 years. So this is the basic situation where an ownership change occurs and where these NOL limitations come in. Now, to calculate that NOL limitation, the annual limit on NOL usage is calculated by multiplying the fair market value of the corporation's stock before the ownership change by the long-term tax-exempt rate. And again, we didn't go over the tax-exempt rate because that changes year to year, and that's not really what this topic in the blueprints is focusing on. We're just talking about the basic concept and the definition of these things. For built-in gains, recognized built-in gains within 5 years of the ownership change can increase the annual limitation on NOL usage. And if you think about it, this kind of makes sense because if there's more gains to be used that existed before the ownership change, then they can use the net operating losses that existed before the ownership change against those built-in gains. Now, for the continuity of business enterprise, and this is a requirement, the corporation must continue to operate at least one significant historic business line or use a significant portion of its historic business assets to meet COBE requirements. And again, this is just a reminder, this is to basically prevent them from purchasing a whole bunch of other loss corporations just to use their NOLs. And finally, in bankruptcy, if creditors and shareholders of the old loss corporation end up owning at least 50% of the new corporation, the annual limitation on NOLs may be increased. So this is a pretty small topic on the CPA exam. So we looked at a whole bunch of different ways it could be tested on the exam. Again, it's a pretty small topic, so any one of these questions could be what you need to know for the exam. And with that, that is the end of the video. Thank you for watching. Make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. Again, it is free, and we will teach you the key ingredients to passing the CPA exam. Make sure you go check it out. Also, if you like these 5 questions, remember that Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it and more practice by becoming a Superfast CPA member. If you like the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.